Hello, good morning, everyone. Kindly confirm if you can hear me, David.
Yes, we can hear you.
All right, thank you. Good morning, everybody. On behalf of Shelze Professional Services, I want to welcome you to our tax webinar with the title Place of Residence. And today we are going to be discussing a very different interesting topics which spans across statutory framework, which is NTA 2025 and NTA 2025, and its provisions on territorial attribution and residence determination. We're also going to be taking you through residence rules, multiple residence rules, and what the law says about itinerant workers, documentary requirements, practical case studies, some of the common pitfalls that organizations face, and our compliance recommendations. So, ladies and gentlemen, on behalf of Shelze Professional Services, we welcome you to today's webinar. So, to begin this webinar, I'm going to be introducing some of our seasoned speakers, starting with David Apaflo. So, who is David Apaflo? David Apaflo is the managing partner and CEO of Shelze Professional Services. He also doubles as a fellow of ICANN, a fellow of CITN and IMC. Mr. David Apaflo is a first-class accounting graduate. He also doubles with an MBA from Lagos Business School. He is an ICANN fellow, which he achieved at the age of 28. Mr. David is a seasoned consultant and he advises multinational organizations on tax strategy, payroll compliance, and fiscal governance. Our second speaker is Mr. Friday Samson. Mr. Friday Samson is also a seasoned tax professional with a Bachelor of Science degree in accounting, and he also doubles with a master's degree in finance. Mr. Samson is an associate of the Institute of Chartered Accountants of Nigeria and also the Chartered Institute of Taxation Nigeria. Mr. Samson is the tax manager at Shelze Professional Services, where he advises different clients on compliance and how to follow the legal framework and PAYE jurisdiction reviews. The third speaker that I'll be calling on is also David Oparinde. So David Oparinde is a member of the Institute of Chartered Accountants of Nigeria. He is a first-class graduate in accounting, and he also supports the firm's tax advisory practice with great expertise in personal income tax legislation. To begin this webinar, we are going to be having a quick engagement poll, which is going to be coming up on your screen right now. So we should be seeing the poll right now, and we want each and every one of you to attempt the polls. Thank you. We'll be giving 1 minute to gather the answers for this poll. Thank you. Okay, so getting some interesting responses. We'll be publishing the results of the poll now. Based on these responses, we can see that some participants are having doubts or misconceptions about where PAYE should be remitted for this employee. To unpack that, Apaflo to help us clarify. Over to you, David Apaflo.
All right, good morning, everyone, and thanks for being here. As we can see, the issue is not merely a jurisdictional one, so it's not a computational one. A lot of companies actually compute the PAYE correctly, right? And where we see a lot of companies missing it is in terms of the attribution to jurisdictions. As we might be aware, Nigeria has 36 states and the Federal Capital Territory. And so sometimes some of these payments get misallocated, and get misattributed to the wrong tax authorities. So the real issue here is a jurisdictional compliance risk. And that risk can be really, really impactful when you look at the scale of some of these PAYE remittances that are misallocated or misattributed to a different state IRS. And in today's training, we're just basically going to be looking at the deep dive, the legislative framework that guides the space of residence.
Are you still speaking?
As we all get acquainted with the Nigerian Tax Act and its implications and practical applicabilities for us in our companies, our businesses, and our roles. So I'll just hand over to my colleague who will be taking us through the details of this session. Thank you very much.
Thank you, David. So, to understand the Nigerian tax landscape,
Mr. David.
Some of us might already know Nigeria operates a subnational system.
Some technical issues. So the question will be calling on David Oparinde to take us through the legal standpoint of where PAYE should be remitted. David Oparinde will be expecting you now.
Can you hear me now? All right. So as I was saying, Nigeria operates see the reactions. Thank you. So Nigeria operates a subnational tax system, as we already know, which means that each state is responsible for receiving the PAYE for their residents within their territory. We do not have a central federal pool for PAYE as it is in Nigeria. And then, this raises some structural challenges where we have employers who have employees in multiple states. We also have workforce that get to move from state to state due to the nature of their work. Post-pandemic, we also have more remote workers. And these are some of the structural challenges that we get with the tax landscape that we have in Nigeria, and raises some compliance risks for employers getting to know which state exactly is the PAYE for their employee expected to be remitted to. So the legislative framework that governs PAYE and every other tax in Nigeria is the Nigeria Tax Act that was recently, enacted, as well as the Nigeria Tax Administration Act of 2025. So it is the primary legislation that has imposed, and it defines the charges that for taxes on individuals and for entities in Nigeria. It helps with the territorial attribution, so each state knows what PAYE is due to them. And the NTA and NTA on this particular topic work hand in hand, as they have similar and identical approaches on defining how the framework for personal income tax works. So now let's go into the definition of place of residence, which is the crux of this webinar. So based on the Nigeria Tax Act, it defines a place of residence as a place that is available for domestic use of an individual in Nigeria on a relevant day, and does not include any hotel, rest houses, or other places which he temporarily lodges unless no permanent place is available for use on the day. So that's the definition that we see in the Tax Act verbatim. And then the first schedule of the NTA 2025 paragraph 12, that's where we see that definition, as well as in the 12th schedule of the NTA, there's Nigeria Tax Act 2025. So let's just look at this definition in a word by word analysis. So in the definition, we see highlighted available. So the accommodation must be genuinely available for use, not merely owned. It doesn't, just the fact that you own it does not mean that it's available for your domestic use. So it must be available. And then for domestic use, it means that the place must be suitable for habitation. So when an employee sleeps in the office space, it's not exactly suitable for domestic habitation. So it's not suitable for domestic use and doesn't qualify. And then the final word that we'll be analyzing is relevance day. And typically, this means January 1 of the assessment year in question. So let's say 2026, the relevant day, according to this definition, would be January 1st. And the core principle, basically, in this definition is that availability is what is most important, not exactly that the employee is physically present at that accommodation, at that place of residence, but the fact that it's available for his or her domestic use would make it qualify as a place of residence. And so some examples of places that may qualify as a place of residence are owner-occupied residential buildings. So a building that is owned by an individual, whether built or purchased. And then we have long-term residential tenancies, rent, lease, whatever the case might be, and also employer-provided housing. So residential accommodation that has been provided by an employer for an employee also qualifies as a place of residence as much as it is physically available for use, it is legally available. That is, the owner or the resident has right of occupancy to stay in that accommodation, and then it's available for domestic use, and the duration of that stay is not temporary. So according to the law, places that do not qualify would include hotels and service apartments, rest houses, guest houses, and other temporary lodgings. I mean, based on the definition, these are transient places and they're not particularly available for use for residents over a long period of time. Next slide, please. So we've come to the most important part, the most important rule that governs place of residence in Nigeria, and that is the January 1 rule. So the January 1 rule is the primary determinant that the NTA 2025 has stipulated when it comes to attribution of revenue or income of individuals, or when it comes to remitting revenue correctly. And what does the January 1 rule, what does the primary rule say? It says that where an employee has a qualifying place of residence, the employee is deemed resident for the entire assessment year in the territory where full residence is located on 1st January of that year. So just to rephrase, wherever an individual is deemed resident on 1st January is where they will be deemed to be resident for the rest of that assessment year in question. And there are a couple of reasons why the law has stipulated January 1st. I mean, it's certain, it's simple to use, and there's more consistency when there's a specific date that is already set out. So the January 1 rule is the primary rule that determines place of residence in Nigeria. So we'll be running a poll now that would just to check our knowledge level on whether or not we are familiar with January 1 residential. So our moderator will help us with that.
Thank you very much, David, for that clarification on the legal standpoint about place of residence according to NTA and NTA 2025. So just to test our learning, we are going to be attempting the second poll. So you should have seen the second poll on your screens right now with the question: before today, were you familiar with the January 1 residence rule? So we'll be taking 1 minute for everybody to answer the polls. Thank you. All right. So we'll be displaying the results of the poll now. Okay. Yes. So 48% of the participants said they are not familiar with the January 1 residence rule. So this is exactly why we are having this webinar. But before we move on to answer this question, David is on the call. So we would like to take his comments on why exactly we are having this webinar. So that was what we're waiting for before the network dislodged that. So we'll be having David Apaflo shortly now to take us through why we are having this webinar. Thank you.
Okay, so so far we've learned about the January 1 rule, and it basically underscores how important it is for us to, attribute taxes properly, because you can compute your taxes correctly, but if the attribution is wrong, sometimes it is as good as not even contributing or, making those payments. And, in this instance, so it means they are dealing with two risks. There's the computational risk and there's the attribution risk. So in this instance, right, you compute your payee properly, so you've dealt with the computational risk, but the attribution risk is still something that now raises its head. And sometimes, depending on the quantum of tax payable and the number of states involved, I'm sure you agree with me that the headache that comes with that sort of misattribution or misallocation to state IRSs can be very hectic. And so Nigeria has 36 states and the Federal Capital Territory. So that's 37 taxing jurisdictions when it comes to PE. So it is very important that we do not misallocate among these 37 taxing entities. And that's exactly why we've gathered here, to be able to share our knowledge and put heads together to understand this subject very clearly, especially with the Nigerian Tax Act coming in force. Thank you, Kola.
Thank you very much, David, for explaining why we need this webinar. Going back to the question we asked initially about the January 1 residence rule, I'll be calling on David Oparinde to help us clarify what the January 1 residence rule means and how it is applied. David Oparinde, over to you.
All right, so let's see how this applies practically. So as I earlier mentioned, where an employee is resident January 1 of a particular assessment year is where they are deemed to be resident for the rest of the assessment year, regardless of mid-year relocations, regardless of multi-state work. So let's consider mid-year relocations. For example, an employee, and we have an example here of an employee who lives in Enugu on January 1st, and then in June, they relocate to Abuja for the entire assessment year. However, based on the January 1 rule, their payee continues to be remitted to Enugu State IRS because as of January 1, which is the relevant day according to the Tax Act, they were residents in Enugu State. So regardless of the relocation during the year, 100% of their payee for that year still goes to Enugu State. And then it's until next year where, if by chance the individual is staying at Abuja, that would be where their payee will be remitted to for the following year, because as of January 1, they'll be at Abuja. Can you hear me? If we can. All right. So I was speaking about employment commencing mid-year. So if an employment commences during the year, an example is an employee that starts work on March 15 with a particular employer. So the residence for that individual, or the relevant day for that individual, would not be January 1st, because for that employer's records, the employee was not in their employment as a January 1st. So the relevant day would be the first day of the employment. So we have an example of someone who resumed on March 15 and was resident in Kaduna State. So if they relocate before the year end, all of their PE would still be remitted to Kaduna State, because as at the first day of their employment, they were a resident in the Kaduna State. We also have another scenario of multi-state work, which might be popular amongst some employees that have to work between different states. So we have an employee who lives in Lagos as a January 1, but then during the year, they work some parts in Lagos, they work some parts in Delta State, they work some other parts in River State by nature of their jobs. 100% of their pay is still going to go to Lagos State IRS, because they were deemed to be resident as a January 1st in Lagos. So many payroll systems and HR departments operate on the assumption that pay should follow the work location. But according to the law, this is incorrect. So it creates some form of systematic jurisdictional errors. So the wrong assumption that most payroll systems or most HR systems have is that if an employee works in Lagos, our office is in Lagos, and so their pay should be remitted to the Lagos State IRS. However, payee goes to the state where the employee is resident, regardless of where they work. So the law is very clear on that fact. The first ranking test is that of residence, not of work location. Next slide. So now we have established what the primary rule is, and that is in the event that an employee has just one place of residence. But then we come into a situation where an employee has more than one residence that has passed the statutory definition test according to the Act. So it means that it is available for their use and it's available for their domestic use as at the relevant day. So they could own a building and could also have maybe a rented apartment somewhere. That's just a scenario. So where two or more places are available for their domestic use in different states, what the law says is that one of these places has to be designated as the primary place of residence. And then the law spells out a category-based test, different categories of taxpayers. So for pensioners, the place where the individual usually resides would be their principal place. For unearned income earners, it would be the place where the individual also resides. But for our focus of this training, which is that of earned income earners, the principal place would be the place that is nearest to that individual's usual place of work. So it raises a test. It raises a test of how do we now determine the usual place of work? How do we determine which is nearest? And what are the evidences that are required? So the usual place of work, there's a factual analysis that needs to come into play to determine what would be the principal place. And that is where the employee usually performs their duties. They usually perform their duties. So nearest would be by geographical proximity or travel time in the event that proximity is almost similar, then travel time comes into play. So those are the tests that would be carried out in order to identify an employee's usual place of work. So the place that is nearest to where they would usually work would be deemed their principal place. So let's walk through some case studies just so that we understand. So let's meet David Etin, who is a petroleum engineer with an international oil company. So he has his family home in Lekki Phase 1, Lagos, and then he has a work state accommodation in Port Harcourt, Rivers State, that has been provided by his company. And then David's work pattern is that he works 60% of the year in Rivers State at the offshore facility, and he works 25% of the year at the Port Harcourt office, and then 15% of the year he was at Lagos. So when we are doing this factor analysis, the first step will be that we have identified multiple residencies. He has his family home in Lagos, and then he has an accommodation that's been provided in Rivers State. So first, we've identified that there are multiple residences. Then the second would be to determine his usual place of work. His usual place of work, based on this, is in Rivers State, because we see that most of the time is either at the offshore facility in Rivers or the administrative building in Port Harcourt. But most of the time, which is 85% in this scenario, he is in Rivers State. So then we apply the principal residence test here. Which of these residences, whether it is that in Lagos or that in Rivers, is closest or is nearest to his usual place of work? And that is the one that has been provided by the employer, which is also in Rivers State. The second case study is Amaka, who is regional director of a bank, of a commercial bank. She also has a primary home address at Ikoyi that she owns, and then she has a family home at Abuja. And Amaka has worked she works 75% at the head office in Lagos, and then 20% of her work pattern is attributed to branch visits across numerous states. And then 5% of the time she's at Abuja attending CBN meetings. So following that factor analysis, we've first identified that she has multiple residences. The next is to identify a usual place of work. 75% of the time, she is working at the head office in Lagos. So that is her usual place of work. Then we consider which of our residences is nearest to the usual place of work. And that would be that in Ikoyi, because it's in Lagos, as against the one in Abuja. So Lagos State would be where a PAYE should be remitted to. We then have a final case study of Mr. Emmanuel, who also owns an accommodation in Lagos. He has rented an apartment in Lekki, but then his family home is in Oyo State. And he typically works in Lagos Island. The telecom company where he works is located on Lagos Island. So we apply the same rule, which is nearest to his usual place of work, which is Lagos Island. And that would be the Lagos office. All right, so we'll be running another poll now just to test our knowledge.
All right, thank you. Thank you so much, David, for that wonderful presentation. So we have now understood the meaning of January 1 residence rule. You've taken us through different case studies, but we now want to test our knowledge about the things that we've learned so far in this webinar. And we are going to be looking on our screens right now. So if you check your screen, you would see a poll on your screen about an employee who lives in Ibadan, works in Lagos, and is looking for where his or her PAYE should be remitted to, whether to Ibadan or to Lagos. So we'll be expecting our answers to this poll, and we'll be leaving 1 minute to answer this poll. And while that is going on, so we have been getting some questions in the chat box, some very, very interesting questions. So we want us to ask our questions because we are going to be answering all of these questions before the end of this webinar. So we are going to be waiting for our response to the polls now. Thank you. Okay, we've gotten wonderful responses on the poll. So 26% chose Lagos as the place of remittance of PAYE, 55% chose Oyo, and 2% chose both, while 21% said depends on January 1 residence rule. Okay, we are going to be calling Mr. David Oparinde to help us clarify where should this employee remit his pay. Mr. David, over to you.
All right. So from the results of the poll, we can see that a number of us already understand the concept. So we have an employee that lives in Ibadan and then works in Lagos. Where should his pay be remitted? So the rule is residence over work location, residence over activity. So he resides in Ibadan, and so his pay should be remitted to Oyo State because Ibadan is located in Oyo State. So regardless of where he works, because he resides in Ibadan, his pay would be remitted to Oyo State Internal Revenue Service. All right, so we'll be moving on very quickly now to one of the most misunderstood categories when it comes to residents, and that's understanding itinerant workers. So the law defines itinerant workers as individuals other than a government security officer who works at any line in any state during an assessment year for salaries or whatever form of livelihood, provided that the individual works for a minimum of 20 days in at least 3 months of that assessment. So from this definition, the first thing we can see is that we have government security officers excluded. And that is because they are under a separate income tax regime. So for government security officers, their personal income tax is remitted to the federal pool, not to the states where they reside, so the rule does not apply to them. So we have them excluded from that. And then the next thing we see is that you must perform work in more than one state for a minimum of 20 days in at least 3 months of that assessment year. So the typical misunderstanding that we usually have here is that once employees travel, they are usually classified to be itinerant, but that's not what this definition says. They must also qualify this rule here that says that a minimum of 20 days in at least 3 months of that assessment year before they can qualify to be called itinerant worker. So the first filter, when we have situations of staff or employees working in multiple states, is do they have a place of residence? If they have a place of residence, then we revert to our first rule, which is the primary rule, January 1 rule applies. So itinerant workers only come into place when 2 conditions exist. First, the individual does not have a place of residence, and second, it fulfills this threshold of 20 days in at least 3 months of that assessment year. So let's just break down this threshold into more detail. So it's a threshold that must be met cumulatively. So 20 days minimum in each month, and then that must have happened for at least 3 months in a particular assessment year. So, I mean, the purpose of this threshold is just to ensure that we do not have incidental classification as itinerant workers. The fact that someone had to go to a state and just worked for 10 days or worked for 15 days and then had to come back does not make the person an itinerant worker. The person must have worked 20 days minimum in each month. So there are some examples here that do not meet the threshold. We have an employee that works 15 days in Lagos, 10 days in Ogun across the entire 12 months. That individual is not itinerant. He has not qualified to meet this threshold. Another employee works 25 days in Lagos, 25 days in Ogun, but across just 2 months of the year. So he was not up to the minimum of 3 months. So that person is not itinerant. A third example is an employee that makes occasional site visits, 5 to 10 days in other states. That individual is also not itinerant. But an example of an employee or an individual that meets this threshold is an employee that works 22 days in Lagos, 20 days in Ogun, and then 20 days in Delta across 4 different months. So has met both categories, 20 days minimum and then more than 3 months. So like I mentioned earlier, the fact that an employee travels from state to state does not necessarily equate or make that person itinerant. There's a sequential analysis that needs to be carried out. First, does that employee have a place of residence? If yes, then the issue of itinerant does not even come up because the person has a place of residence where their pay can be remitted to. Then the second one, if the person has no residence, then we apply the itinerant worker rule. As the person worked 20 days minimum in at least 3 months of that year. So the fact that, again, the fact that a person moves from state to state does not make them itinerant. The first filter that we should always take note of is whether that person already has a qualifying place of residence. If the person does, the person is not itinerant. So let's walk through some case studies. We have a regional sales rep, Chioma, who works for an FMCG. So she has a place of residence in Lagos. She resides at Yaba. But then, due to the nature of her work, she moves from the Lagos office. She works 12 days in a particular month at the Lagos office and 8 days at the Ogun office, 6 days at the Oyo office, and then the remaining 4 days of the month, she was at home in Lagos. That is the weekend. So the first thing we need to consider is, does she have a place of residence? Yes, she does. She resides in Yaba, and as such, the itinerant rule does not apply to her. So the January 1 rule would apply in this case. So 100% of her income would be due to the Lagos State Internal Revenue Service. A second example would, okay, let's just move on to the secondary rule, where we have no fixed place of residence. So we have now established that this individual in question has no place of residence. So the individual is on the line of being classified as itinerant. How do we now attribute the income that this individual earns? So when it has been established that a particular individual has no established place of residence or principal place of residence, for example, if we have a peripatetic consultant who maintains no permanent domestic base anywhere in Nigeria, then the income source attribution is the rule that applies to itinerant workers. So each state where that itinerant worker has worked would have their pay for that amount that is earned in that state remitted to the relevant state. So the pay will be apportioned based on the states where the individual had worked in. But I mean, this issue of itinerant workers does raise many problems because there would be, the individual would need to register with multiple state internal revenue services. The employer would also have to do that. There would be a lot of record keeping. It leads to a lot of high audit risk because there would be so many discrepancies or so many states wanted to lay claim on that individual's income, despite the fact that the individual was just moving from one state to the other, but it raises so many concerns. So let's look at an example of such an individual. We have Dr. Fatima, who was previously resident abroad, but then she has returned to Nigeria and works as a management consultant. So based on our project assignment for 2025, she worked in Lagos for 65 days and then worked in Abuja for 48 days and then moved to Port Harcourt for 62 days and then eventually worked in Kano for another 55 days. So from this, we've seen that at least she has worked in more than 3 states and she has also met the threshold of 20 days minimum across these states. So in this event, our pay is going to be apportioned. So our total income that she has earned in the year 2025, which is in focus, will be apportioned based on the number of days she spent in this state. So for Lagos, it would be 65 days divided by the total number of days that she has spent in the year. And so for Lagos, based on the percentage, you have 28.3%. We have for Abuja 20.9%. We have for Rivers, which is Port Harcourt. Based on that percentage, her PAYE is going to be apportioned because she doesn't have a qualifying residence. Just to sum all of these three scenarios that we have considered up to consolidate our knowledge, we have three scenarios that we've considered. First is a single state residence. So we have an employee, which should be the most common that applies to most people. An individual owns one place of residence or has one place of residence in a particular assessment year. That individual's, the rule that applies to that individual would be that of the January 1, the primary rule. So where the individual was deemed to be resident on January 1 is where 100% of their PAYE for the year goes to. Then we moved on to multiple residences. So an individual has two or more qualifying places of residence that have met the statutory definition. Then we now do the factual analysis of which is the nearest place to that individual's usual place of work. And the rule that would apply there is the principal residence rule, the one that is nearest to the usual place of work. So 100% of that individual's PAYE would go to the state and residence that is closest to their usual place of work is. And then we moved on to an individual who has no qualifying residence in Nigeria, an individual that does not have a place of residence in Nigeria. And the applicable rule is the itinerant rule, which is the income source attribution. So the PAYE will be apportioned to the multiple states that the individual has worked in. So we'll be having another poll come up shortly.
Thank you very much, David, for that wonderful explanation on multiple residents and on itinerant workers. So that is also one of those technical issues that people have. But thank you for helping us break down the position of the law on itinerant workers and workers who have multiple residents. So we'll be sharing our last poll. So that should be coming up on your screen right now, which says, does your organization currently maintain documented employee residence records for payroll purposes? So we'll take 1 minute to get feedback on that question. Thank you. Okay, ladies and gentlemen, we are getting some very interesting responses on the poll. About 28% said they are not sure if the organization maintains proper documentation. About 23% of our participants said no, and 50% say the organizations maintain proper documentation. Well, this is not far-fetched. So this is what happens on the field. And that is why I'll be calling on Mr. Friday Samson to take us through appropriate processes that we are meant to follow. Over to you, Mr. Samson, to help us anchor this segment. Thank you.
Okay, Kola, thank you for calling on me. So I'm going to speak into what happened in practice. So what we are seeing in practice is that many organizations are reviewing their payroll structures, and this is being done according to the new NT is the Nigerian Tax Act framework, right? So I'll tell you that the issue surfacing most frequently include pay going to incorrect states. This is challenging. So we also have absent resident documentations. We have unclear itinerant worker treatment, payroll system that defaults to office location. This is not the list anyway. So for organizations that recognize any of these patterns, right, the most efficient starting point is typically what we call a payroll jurisdiction, review. This is a focused engagement. Usually takes 2 to 3, weeks, where we, get to review head count data, right? Then map residents against remittance employee and identify misallocations. The output is a clear report with a recommended, action plan. So I would say if any of these issues, discussed today resonates with your organization, we will be so happy to have a brief, no obligation conversation about whether the payroll judicial review will be appropriate. So that's what I can speak to that. So please, Kola, over to you.
Thank you, Mr. Samson, for taking us through what happens in reality. So we've seen that a lot of people, a lot of personnel and organizations are having this challenge, as you have rightly mentioned. So I can see some people are raising their hands. So I can see a certain person, Yahaya. Mr. Yahaya, you are muted. Would like to hear from you. Okay, since we just lost Mr. Yahaya. All right, so we are also seeing different questions in the Q&A section. So we are going to be picking some questions. We're going to be picking about 3 to 4 questions because of our time. But in this webinar, we have been able to answer the question on the legal position on place of residence. We've also been able to resolve where itinerant workers and workers who have multiple residences should be able to remit their payee. And we have also been able to explain the position of the law and the changes that have been made in the new Tax Act 2025. So as to summarize the things that we have learned in this webinar, we're calling on Mr. David Apaflo to take us through some of the key takeaways that we'd like to recall. Thank you.
All right, thank you, Kola. Just as Samson has said, we see a lot of these things on the field, and you are really not alone. So maybe that should be the first takeaway, that if you find any gaps, you're not alone. 4 key takeaways: residence over activity. It really doesn't matter where your work is performed. If you have to travel out of your home state, to perform your work in a different state, and we looked at multiple scenarios, what really determines where your payee goes and the state you remit your taxes to is based on your place of residence. So irrespective of where you do your work, your payee should be remitted to the state that you live. So it's really, really important that we have that. Now, after establishing that, the critical point is that, it is about the place or places of residence that you have at January 1st. So if you have one place of residence, that's really easy. Wherever you have available for your domestic use on January 1st is your place of residence, and it then follows that whatever state that place of residence is in, then becomes the state government that your PAYE goes to. And of course, if you have more than one place, then we can then start asking questions like, what is the principal place? And that only comes up when you have more than one. And if you don't have any place of residence, then you might fall into the itinerant category. So the January 1st rule is the very, very critical one. Another critical point is documents. Documents are essential. By the time the tax authorities call for an audit or a review of your PAYE records, it is the documents that you have that you use to plead your case, and they are the reference points, and they can stand the test of time even when you have staff attritions and people moving and going, right? Final takeaway is that the cost compounds. An error spotted today and we leave to fester for months and for years, of course, with the interest and penalty regime that the Nigerian Tax Act has brought to us. Sometimes your penalty and interest can eventually be more than the principal sum. And so it's important that some of these gaps are closed as fast as possible. So it's important that you remember the framework and the principles that we have discussed here. We'll also send more details in coming minutes. Thank you.
Thank you very much, David Apaflo, for those key takeaways. So even if you don't remember anything in this webinar, you'll be able to remember these 4 key takeaways that can be helpful to you and to your organization in dealing with the residents and multiplicity of residents. So before we round off, we're going to be taking 3 questions. So we have been getting a lot of interesting questions in the Q&A section. So I'll be starting with first question, which says, what if we've been remitting to the wrong state? Are there penalties? So this is a very, very interesting question, and I'll be calling on David Oparinde to help us answer this question. Over to you, David. Thank you.
All right. So in the event that remittance has been going to the wrong state, the remedial action to do would just be, going forward, ensuring that remittance is now sent to the correct state based on the residence rule or whatever rule applies to the employees at the moment. Once compliance is now enabled going forward to ensure that, once you get documents to back up where your employees are residing, then you can always ensure that their PAYE is remitted to the correct state. That is in the event that, based on this webinar, you found out that some of the PAYEs have been remitted to the wrong state. So going forward, they should be corrected to, they should be remitted to the correct state. But then, it also, as David Apaflo had mentioned earlier, there could be liabilities, penalties that may arise from those states according to the law, because the remittances should have been remitted to them in the first place or remitted to the wrong states. So there's also the possibility of that exposure to a liability, but just ensure compliance going forward.
Thank you, David, for answering that question. So we'll be moving on to our next question. So I can see in the chat box, someone asked, my firm has employees in more than 10 states. Where do we start the PAYE remittance process? So this is a very complex question. So I'll be calling on Mr. Friday Samson to help us clarify this, please. Over to you, Mr. Samson.
Okay, sorry for that. Okay, Kola. Okay. As regards your question, what really matters is extraction of these head counts of these employees. What would definitely help also is that the mapping of the residents against remittance states. And once you are done with that, you can as well identify the mismatches, right? And this mismatch typically cluster in predictable patterns. The focus review identifies, key exposures, and this can probably take like 2 to 3 weeks. So I think the important thing here is just to do the head count. You extract, then do your mapping of the residents against the remittance states, and you can able to determine, the mismatch. Then from there, you can able to resolve the issues, arising from your review.
Okay, thank you very much, Mr. Samson, for that explanation. So we'll be moving to the last question
Kola.
for this webinar by Temitope Oloruntoye. So the question goes like this: how do we deal with remote workers and whose principal is in another state or country? Okay, it's a single question. It says, how do we deal with remote workers whose principal is in another state or country? Oh, I think what this person is asking is, how do we deal with remote workers whose employer is in another state or in another country? Okay, I'll be calling on David Oparinde to help us answer that question. Over to you, David.
All right. So, can you go over the question again?
Okay. The question goes like this: how do we deal with remote workers whose employer is in another state? So let me give an illustration. So let's say someone is a remote worker, and they are residents in Lagos, but their employer is in Ogun State. So where would they pay their pay to? Which states would they be paying their pay to? So that is the first leg of the question. The second leg of the question is, if the employer of such an employee is from a foreign country, so where would they remit their pay to?
All right. So, as we have learned, based on the rule that the law stipulates, it is the employee's residence that is the first ranking test. So, whether or not the employee is remote, the place of residence determines where their payee gets remitted to. So, if we have a remote worker that resides in a state different from where their employer is, it is their own state of residence, that where they have been deemed to reside on January 1st, that pay would be remitted to. So residence usually takes first ranking preeminence when judging where pay should be remitted to.
All right, thank you very much, David, for answering that question. So ladies and gentlemen, we've come to the end of this webinar. So we would want us to share on social media and on different social media platforms what we've learned in this webinar, so we can share that using hashtag #ShelzeWay or Shelze Tax Insights. So you can go on Instagram, you can go on LinkedIn and share some of the key takeaways that you've learned in this webinar and how that can be helpful to you and to your organization. Apart from that, we are not just going to be leaving you in this webinar, we are also going to be giving you different gifts. First of all, we are going to be giving you a tax compliance checklist, which is going to be sent to your mails within 24 hours. Apart from that, we are also going to be sending a complimentary diagnostic conversation template where we used to invite you for a prospective complimentary diagnosis of your organization. And conclusively, we are also going to be having another webinar, which is coming up next month, April on the 14th. So this webinar is titled, "Are you leaving money on the table? VAT input claims, self-charge obligations, and the CIT deductibility trap under NTA 2025. So what should every CFO and finance manager know about VAT input claims? What has changed in the law when it comes to VAT, and how can you navigate those hurdles? These are some of the things that we are going to be discussing in our next webinar. But for now, thank you for your time, and we look forward to continuing the conversation. Thank you and have a great day.
Thank you everyone for joining. Thanks, Kola.
Thank you for joining.
I'm seeing some people say they have questions. Please feel free to send us an email, tax@shelze.com.ng, and we do well to answer all the questions that we're not able to take in this session. Thank you.